Good morning, Monica.
Good morning. Good morning, everyone. Welcome to today's free pension clinic session. My name is Monica Shirwatso, a Customer Experience Officer at Octagon Africa. And today is another opportunity for us to get to learn more of the retirement options that are available to us. And we continue to share with you best practices to adopt to ensure that you continue to enjoy a guaranteed financial security, even in retirement. So feel most welcome to today's session. And as is the norm, kindly feel free to share your questions in the Q&A section so that we can get to address them as we go along. With me today in this session is the Octagon team. We have Davis Ongiro, the General Manager, Octagon Insurance Brokerage Limited. We have Rogata Nafula, Business Development Officer. And we have Jonathan Langat, Business Development Officer. Our facilitator for the day is Davis Ongiro, who is ready to enrich us with knowledge on the subject matter of retirement. A brief background to who we are as an organization. We are a global leader in employee benefit services, property management, insurance brokerage and trainings, both for public and private sector organizations. In Kenya, we have branches in Kisumu, Eldoret, and Mombasa. And in line with our Pan-African dream, we have operations in Kampala, Uganda, and Lusaka, Zambia. So without further delay, I want to welcome the speaker for the day, Davis, to share with us what he has today. Davis, karibu sana. Thank you.
Thank you so much, Monica. You can confirm you can hear me?
Yes, confirmed, Davis, audible? I can hear you. You're audible, okay. and your screen is also visible.
Okay. So, ladies and gentlemen, allow me to welcome you once again to today's session, where we will be talking about the journey to retirement, a very great discussion that all of us must have at a certain point in life. And we are happy and we are excited as Octagon to have that session with all of us today. For some of us in today's event, it comes too early. For some, it is the right time. For some, probably it's a bit late, but we'll have to accommodate all of us in this today's session. And so without much ado, as introduced, my name is once again is Davis Ongiro. I'm the General Manager for Octagon Insurance Brokers Limited, which is a subsidiary of Octagon Africa Financial Services Limited, which has already been introduced. Our business is to guarantee financial security, whether it is you as an organization or even you as an individual. So we very much understand financial security affects all of us in one way or the other, and it affects too many aspects in our lives, whether it is economic, social, political, religious, all that. We have to ensure that we have a guaranteed financial security for all of our clients. We do many other activities, as been mentioned. One of it is pension administration, pension consultancy, pension trainings. We do insurance brokerage and many other services, financial services. We are properly licensed by the Retirement Benefits Authority. We are licensed by Insurance Regulatory Authority of Kenya, Insurance Regulatory Authority of Uganda, and the Pension and Insurance Authority of Zambia. We have trained quite a number of people, exceeding hundreds and thousands of members, and over 10,000 of trustees over a period of time. So you will be advantaged because you are talking to experts in today's session. So you will have the opportunity to learn very many things out of our expertise. Our vision is to enrich your lives through innovative financial services, and you will be able to see that how innovative we have been, how innovative we are, and how we'll be able to make sure that every other time you are financially safeguarded. Mission will safeguard the financial future of our customers through lifelong learning, risk management, and retirement solutions. Values, one of it is customer intimacy, then integrity, respect, and innovation. We started in the year 2007. We are in 2021 now. We have very many things have happened since then. And but probably for today's session, one of the major important aspects is we have been able to launch what we call 2 products. One is called Octagon Income Drawdown Fund over time, and the other one, Octagon Post-Retirement Medical Cover. Those are retirement products which are extremely very relevant for today's session. We have awards. We've won awards before. One of it we featured during the World Finance magazine as the best pension services provider. That is the year 2016. In 2019, 2018, we featured in amongst the fastest growing mid-sized companies in Kenya. This year we won the 2 awards in terms of brokerage, where we were second runners up for the General Insurance Broker of the Year and also the overall Best Insurance Broker of the Year for the year 2020. We are hoping also in 2021 we'll have even more awards. We, particularly for brokerage, we are doing all services for insurance, whether it is motor vehicle, medical, general, life, whether it is individual or it's corporate, we do all of that. So, and we have very, very good rates that we have been able to negotiate with the insurance companies. So anytime you think of any type of insurance services, don't go too far. Just call Octagon and we'll give you the best solution that you will have never imagined. So there's a question here on my screen, and it's asking, why do employers provide for retirement benefit schemes? Why would any employer be willing to incur a cost? Remember, these are costs. They are not obligated. It's not a must for them to set up a pension scheme for you. It's voluntary. So when it is voluntary, then why do these employers feel so much obligated that they must set up a pension scheme for their employees? One of it is fallback on job loss. If you lose your job today and you are not yet age 50, the law allows you'll access part of your pension benefits, and then even as you try to get another job. If you're above 50, you'll access the full amount, both the employer and the employee portion. Number 2, maintaining your standard of living. We must ensure, and that is the main reason why people save anyway, is to ensure that you have maintained your standards of living. That the fridge you have is fully loaded even until retirement. That your house, you are able to pay rent. You are able to live a comfortable life. You are able to get good health. You can be able to go to a good hospital and see a good doctor to be able to service you well. The other, number 3, there is something called saving culture. Sometimes we have really, especially as Kenyans, sometimes we want to be forced to start a savings plan. And even rightfully so, we have still, pension is a very good avenue. And I think is one of the safest and best savings arrangement, because 1, you will have tax advantages, as stated in number 4. Number 2, the sector or the industry is properly regulated. You don't hear people have lost their pension money. It has not happened in Kenya yet. Number 6, mortgage guarantees, and not alone mortgage guarantees alone. You can also be able now to take part of your pension money up to, subject to a maximum of 7 million, and be able to go and purchase a house for yourself. That never used to happen. From last year, we now have all that. So all you need to do is find out from your trustees, how can I use my pension money to be able to purchase a property or a house for myself, a residential house for that particular nature. And then longevity in old age. Somebody said that you can grow young without money, but it is extremely very difficult to grow old without money. Why? Because in retirement is actually the time where you need more money. You need more money to take care of your health. You need more money to get good health. But importantly also, you need money to solve most of your problems that you have. And if you don't have enough of that money, in fact, to be very particular, RBA did a research, and it recommends that people should have at least 70% of their last salary in retirement every month. Every month, not as a lump sum, every month as a monthly pension. I'll explain to you why. I will not even tell you that the lump sum is the best way to have that money or be able to meet your objectives, financial objectives in retirement. We need to get to a point where, as a country or as a people or as Kenyans, that when we get to retirement, we are financially stable. You don't have to trouble your children to be able to send you 1,000 shillings every Friday evening. They also have their own problems that they should take care of. So you also need to take care of your own problems by providing yourself a financial services arrangement that can be able to take care of all your problems when you are approaching retirement, or even if it is not all of them, nearly all. Medical science also, in terms of research also shows when you have too many problems that you can't be able to solve using your cash, then there are very high chances that it will also end up giving you stress. You'll end up having the lifestyle diseases, be hypertension, high blood pressure, and all those types of lifestyle diseases. So it gives you a problem. There is something you have also, I mentioned the tax advantages. When you save to a pension scheme, you are not taxed up to a maximum of 20,000 shillings per month. So when you are putting money into a pension scheme up to 20,000 per month, you are not taxed. Even if you are taxed, the amount that is above 20,000, it is very little tax. But even so, remember that money that you are taxed at source, you will not be taxed when you will be accessing in retirement. So it still has very many tax advantages. And even if you are taxed, it is very minimal tax compared to other forms of investment that are available in this country. So I've said the reasons why employers provide pension benefits. Something else to mention is there are different types of schemes. There is a state like NSSF, and that scheme for civil servants. There is occupational schemes. That is what most employers set up for their own employees and call it XYZ staff pension scheme, or personal. This is an individual personal pension scheme, which we commonly call IPPs. In Octagon, we have one we call Octagon Personal Pension Scheme. When you are not working, you can continue saving into an IPP fund so that is able to help you build up and have something to share or to spend when in retirement. So your scheme can either be what we call a defined contribution scheme or a defined benefit scheme. Defined contribution scheme means that you are contributing something out of your own pocket and the employer is contributing something out of their own pocket. So the two, employee portion and employer's portion, end up forming what we call a monthly contribution, which is remitted to a pension scheme. And when it is remitted to a pension scheme, it keeps growing, earning an investment income every year, which is credited back to the scheme every year. And that is what makes up the fund. Defined benefit schemes, usually these ones are not very common, especially this time, because employers found them to be more of a liability in one way or the other. So mostly you find defined contribution schemes. But even on defined benefit schemes, the last payment or your last pay will be based on the amount of salary and the number of years you've worked. So even if there are pension scheme, even if there is a DC scheme or a DB scheme, they can further be classified to either a provident fund or a pension fund. Pension fund works this way, that for the lump sum amount that you will have in retirement, for a provident fund, you are allowed to take the lump sum amount. If it is 10 million, you can go with your 10 million and you decide to blow it up in one day. No one has a control over it. But for a pension fund, you can only access a third as lump sum. 2/3 you must purchase what we call an annuity or an income drawdown fund. We will get to learn. My colleague Jonathan will be able to take us through how an annuity works, and then I'll take us through how a drawdown works and be able to compare advantages and disadvantages, and also go ahead and talk about what we call post-retirement medical cover. Remember, the greatest problem retirees have in retirement is not even food. It is a problem to do with their health. So we have a solution as such for the same. So usually most of these schemes are formed under what we call a separate trust. Assets of the sponsor completely are separated from the assets of the scheme. That is why I said it is difficult. It's extremely very difficult to lose pension scheme money because the benefits are different. The assets of the scheme are different from the assets of the sponsor. Trustees are appointed to look after the assets of the benefits of the members and the beneficiaries. The schemes are regulated by Term Benefits Authority and KRA. So purpose of the scheme is to ensure its members and the beneficiaries against the economic consequences of old health, ill health, and death. You can see I have an old mzee on my screen. This old mzee could be enjoying his life at a certain place, probably abroad or somewhere where he has gone to enjoy his life. So ask yourself where probably you could be when you get retirement and whether you will afford that. So I have mentioned where the schemes get money is employer's portion, employee's portion, you NSSF part of the contracted out NSSF Tier 2 contributions, and then the returns of the investment income and per year. That said, there is no rate cast on stone, so you can have the organization can contribute an X amount, member contributes an X amount, that you add X plus X becomes a Y amount of your member's basic salary, of your gross salary. It doesn't matter where that comes. It's basically the decision of the employer to make that decision. Normal retirement age in this country is 60 years, but that will depend whether you are, for example, a professor, that is the lecturers have a different retirement age. But for any other normal employees, mostly you'll find the retirement age is between age 55 to 60 or even 65. The rest of maybe the judges who also retire at 75 years, the rest of the people retire at the age of 60. So your scheme, as I've mentioned, can be a defined contribution or can be a defined benefit scheme. The scheme can be guaranteed or may not be guaranteed. On withdrawal, I already mentioned if you are below age 50, you can only access 50% of your employer's portion, 100% employee portion you can access it. So when you attain age 50, you can proceed or request your employer to go on what we call early retirement. And if they agree, you can be able to access your full lump sum amount, whether it's lump sum or as a pension scheme, depending on the rules of your scheme. Other fully withdrawals, if you are on ill health, if a doctor certifies that indeed you are suffering from a disease which can't allow you to work anymore, members' beneficiaries can withdraw upon members' death. When a member leaves the country permanently, or what we call permanent immigration, or also transferred to another scheme. So this is how a scheme is managed. You will find the scheme has what the people we call trustees. These trustees, some of them are elected by you as a member. Some of them are appointed by your sponsor or appointed by your employer. Then your scheme will have what we call a fund manager or investment manager. We'll have a custodian who is a bank and administrator who does record keeping. And then there are other service providers than the auditor, the actuary, or any other consultants that the scheme or the trustees of the scheme might consider having from time to time. Ideally, I've mentioned how your pension benefits can be accessed and using which route. Something important to mention is that your pension benefits must be paid within 30 days by law. Once you apply, the process should not take more than 30 days. At Octagon, I am excited to mention that we are able to pay less than 30 days because we have the system of the state of the art system that allows us to pay people within 1 week, and we don't get to those 30 days. So we have all the support we need to be able to make that process very simple. Let me give something illustration here. There is something called additional voluntary contribution. Additional voluntary contribution means that you have over and above what is being contributed, you are contributing mandatory from your salary, and the employer does that. You can do something called additional voluntary contribution or contribute on what you call an individual personal pension level. So, and I did an illustration assuming that you are contributing 2,000 shillings per month per year. In the first 5 years, assuming you are running an interest of 4%, you will have 163,000. In the next, maybe assuming the interest grows at 8%, it will be 182,000. Assuming the year will be very nice and you have 12% on average every year, the return will be 200. You'll have at the end of the 5 years, you'll have 204,062 shillings. Assuming the same, you do the same and increase only by 10% every year. In 20 years, you will probably, if you go with an average return of 10%, you will have 3 million, 3.2. In 25 years, it will even be more. In 30 years, assuming you earn an average income of 10%, you'll have over 12 million. Over 12 million. So this illustration is basically to show us how our fund grows. And even if it is a small amount of 2,000 shillings, if invested properly, if you put to a correct scheme, if you put to correct investment managers and service providers like ourselves as Octagon, it can be able to grow to be millions and millions. Believe it or not, it will give you nearly the figure that I've given you on the screen. Taxation of retirement benefit. Something to mention is contributions may be tax deductible. I mentioned already that your contributions are only it's the first 20,000 is not taxed. Anything extra than that is taxed at source. Your investment income is not taxed for the first 20,000 that you contribute. All or part of the pension may not also be taxed, but also depends what determines the rate of tax that you will pay or you will not pay is dependent on the number of years you will be in a scheme. The Income Tax Act, of course, which is under, so if you are, there is something we call a tax band. So depending on the number of years that you have been in the scheme, so for age 50 to 65, the first 600,000 is tax-free. So when you are going to earn your monthly pension, there is a certain amount of at least 25,000 which you'll also be accessing tax-free. Anything above that you are taxed. So the above 65, I know the government is keen on looking at this, probably because the law is not very clear on whether members of pension schemes who are above age 65 should or should not be taxed. So it's something that could always be clarified. We are doing as many deliberations as possible to ensure that we get attention from the government of Kenya to be able to clarify on the same. There is something we usually say is when you are in a pension scheme, please make sure you nominate a beneficiary so that in case you die, God forbid, there are no unnecessary delays in paying out your benefits. It also assists trustees in decision making. So probably today, if you have not retired or you're approaching retirement, or even if you've just joined a scheme, please always remember to update your list of nominated beneficiaries. If you get married, if you divorce, if you give birth to children, if they grow, all that, you need always to keep updating with your trustees so that your records are up to date. Please also make sure to attend all forums organized by your trustees, whether it is an AGM, whether it is member education, whether it is a training. Please always ensure to create time for such trainings because they help you a lot in knowing what is supposed to, you are supposed to know you as a member in the scheme and also be able to enlighten you and upskill you. Members' rights and obligations, of course, to choose how your benefits are treated upon exit, receive benefits within 30 days. There is something to mention is that your benefits cannot be assigned. You can nominate beneficiaries. You can participate in electing your trustees. You can be invited and attend AGMs and plus any other forums organized by your trustees and receive a benefit statement every year. For Octagon, you are allowed to access that every single year. So that said and done, we want to go to the next session, and where I'll welcome in my colleague Jonathan. He will talk about annuities, but before he does that, there is something to mention that when you are approaching retirement, as I mentioned, you have the option to take on a lump sum amount. If it is a provident fund, you can take the lump sum, the full lump sum amount. But if it is a pension scheme, and all government schemes are pension schemes. If you belong or you are working to any government institution, most definitely is that your scheme could probably be a pension fund. So you always need to be very clear with your trustees. But for private institutions, your scheme could either be a provident or a pension fund. In saying so, is that for a pension fund, the law only allows you to access a third as lump sum. 2/3, you must purchase an annuity or an income drawdown. Why does the government force you to take an annuity? It is not that the government will you are giving that money to the government. No. What the government is doing is that they know if they give you a lump sum, there are chances that at retirement you are likely to make bad decisions, which might make you have a loss, especially when we try to starting new business that we've never tried in retirement, and whose risks that are not very clear to us. We end up, our retirees have initially and previously and so many times lost a lot of money in Ponzi schemes. People put money in funny places. Some say they'll put the money in betting. So you take your old pension money and put in a bad scheme. So when you put that in a bad scheme, what that means is that you will be able to lose that money. So the government said that every employee must put aside some money, which they'll take to another insurance company and place there, and the insurance company will give them a monthly pension. From where we sit, and I will always advocate for that, it is better to have a monthly pension of 20,000 shillings for life rather than having a 2,000 shillings that are which you can whether you would rather have a 20,000 shillings that is there for life rather than a 2 million that is in cash. I say again, you rather have a 20,000 monthly pension for life rather than having a 2 million, which doesn't help you in any way. So thank you. I want to stop there and welcome Jonathan to continue with the presentation, and then I'll come back later to proceed with the rest of the presentation.
Davis? Davis?
Yes. Yes.
Before
Monica?
you can move on, because I'm seeing we have a question, I would prefer we get to address them as they come. We have a member, Sarah, asking, if I take pension and buy a house, must I stay in it or can I rent it?
Remember, the purpose of this scheme is you to have a residential house. It is not a commercial building. That is the spirit of the arrangement by RBA. So as much as possible, it is that is the main purpose of that scheme.
She goes ahead to also ask her, the 25,000 that is tax-free, can I choose to take this every month to save myself from paying tax?
Okay, what is she saying? I'm not sure whether I understand that.
I think she's talking about the first 20,000 that is usually tax-free.
Whether she can do what?
Whether she can choose to take this to withdraw that amount every month to save herself from paying tax.
No. But you see, the reason why you are contributing to a pension scheme is that you save on tax. So that 20,000 goes to a pension scheme so that you take advantage of that tax relief. So if you want to access that money, then that means you lose out on your tax benefit. Yeah.
Okay. She's also asking, will you give us more information on annuity and drawdown? Yes, Sarah, we are still ongoing with the presentation. It is part of it. Then Florence is asking, how can I know who my beneficiaries are? Can I change? Yes, this you can, Florence. We make it possible for you to do so through the member portal. So if you do not have credentials to access your member portal, you can always write to us at support@octagonafrica.com. Then we can send you your credentials to access the same. You can be able to find out what it is that you have there and also make the changes. So that is possible. Okay, thank you, Davis. So we can continue going on.
Okay.
Okay, good morning, team.
Morning, Jonathan.
Okay, Jonathan is his machine is misbehaving slightly, but is coming. Yeah.
Okay. Jonathan from Octagon Insurance Brokers. I would like to take you through annuity. This is one of the options that you have at retirement. And an annuity, it's a perpetual payment, which is paid to the annuitant basically for life, as long as you live, and it's only purchased from the age of 50 years onwards. Yeah. And it's subject to a minimum guarantee period. One of the advantages of an annuity is that it protects you from running out of cash. If you're given 2 million cash today, maybe in the next 3 months, you won't have it. As Davis was saying, is that it's better for you to be earning 20,000 shillings every month for the rest of your life than you being given a lump sum of 2 million shillings. Yeah. So basically, when you purchase an annuity, you transfer the risks to an insurance company, where now the insurance company will be giving you a monthly payout for the rest of your life. One of the characteristics of annuities is that you can either be escalating, it can either escalate or be 0%. That means it's level, depending on whatever the option that you choose. Yeah. So the other thing is that you enjoy a tax relief. These are at the time of purchase. This means that your purchase price shall not be subject to taxation, and also there's also a tax relief of up to 25,000 shillings per month. Yeah. So if you have a payout of, let me say, for example, 35,000 per month, the first 25,000 shillings per month is not taxed. Yeah. They're issued by life insurance companies, and then it provides income that you cannot outlive. Yeah. So for us to get you a quotation, what we'll need is the purchase price. Yeah. We'll need the gender and the age. Basically, those are the three factors that we'll need for us to give you a quotation. Yeah. So as you can see here, this is a sample quotation. Now, we talked about the escalation, which we usually have three types of percentages: 0%, 2%, 3%, and 5%. Yeah. About the guarantee period, we have 0% guarantee, 5 years, 10 years, 15 years, and 20 years. Yeah. So basically, what the guarantee period means is that it's the minimum period that the annuity payments must be made, whether the annuitant is alive or not, for the purpose of protecting the purchase price. Yeah. And now about the escalation. Basically, what the escalation means is the percentage increase in the annuity payments every year. Yeah. So let me give you an example of, if you take an escalation of 0%, this means that your monthly payout won't change. Yeah. But if you take an escalation of 3%, it means that the monthly payout will change every year. Yeah?
Sorry, Jonathan, sorry for the interruption, but we are not seeing the screen that you're explaining, where it shows the escalation rate, the example you're using. We are still on the annuity, yes. Yes.
So is it visible now?
Yes. Now we are on the same page. Thank you.
Oh, okay. Now, I was talking about the guarantee period, which, as you can see, this is just a sample that there is 0 years guarantee, 5 years, and 10 years. Yeah. And the escalation, we are looking at 0%, 2%, and 3%. So as I was explaining, the escalation refers to the percentage increase in the annuity payments every year. So basically, if, for example, you're earning 20,000 shillings every month in the first year, this means that in the second year, yeah, that payout will escalate by a certain percentage, either 2% or 3%. Yeah. So basically, the second year will be 1 or 3% of the 20,000. Yeah. And the guarantee period is the minimum period that the annuity payments must be made. Yeah. Whether the annuitant is alive or not, for the purposes of protecting the purchase price. Yeah. Let me give you an example of you buy an annuity in 2020. It has 20 years guarantee period. Yeah. So the monthly payouts will start in 2020, and let's say in the 5th year, God forbid, you pass on. Yeah. This means that there is 15 years that you have not been paid. So these monies will be paid to your next of kin, to your beneficiary. Yeah. And if you take a 20 years as a guarantee period, and then maybe in the 30th year you pass on, God forbid, there'll be no monies to be paid to the beneficiaries because the guarantee period was 20 years. Yeah. Okay. Okay. The characteristics. The characteristics of an annuity. Yeah. So as we talked, they can be the escalating or level.
Jonathan, we seem to have lost you.
Yeah, sorry, I think my machine is misbehaving, but I think let me give Davis to continue.
Okay. Thank you, Jonathan. I'll finish up on that issue of annuities. What basically Jonathan is trying to explain to you is that there is something called a guarantee period. Of course, before we go to the characteristics, of course, one is that they can be either escalating or level. So it is you to decide whether you want an escalating annuity or you want a level annuity. Escalating means it's increasing with time. Usually starts on a lower rate than the level annuity. Of course, then I know, and most reason why people take the escalating annuity is to take care of the inflation in future, and if there are any standards increase in standards of living. So most people prefer going for that option in that context. Something else is that you are enjoying a tax relief of up to 25,000 shillings per month at a time of purchase, are issued by life insurance companies. And there is something else, your annuity can be either guaranteed or not guaranteed. What does guaranteeing mean? Guaranteeing means is that if you don't guarantee, maybe let me start from there. If you don't guarantee your annuity, what it simply means, if you die in the period of you if you die while still receiving your annuity, is that your annuity will also stop immediately when you die. But when you have a guarantee period, and say you take 20 years guarantee years for your guarantee period for your annuity, and you turn on the 10th year, what that means is that the insurance company will pay your nominated beneficiary for the next 20 before the 20 years lapse. So assuming you die in the 10th year of your 20-year period, and you are dying on the 10th year, the insurance company will be obligated to pay your nominated beneficiaries for the remainder of the period. Probably that could be your wife or your spouse. So you have that. Guaranteed annuities have an advantage compared to what is not guaranteed. So every time you take a cover, every time you take an annuity, every time you purchase an annuity, every time you ask for a quote, please always find out how much it will cost you to guarantee the same annuity. Because the guarantee price also, there is a guarantee price, but it's not very expensive compared to you going without it. The other thing that you must know on the types of annuities, one of it is that there is something we call a joint. One is the common one, the single life annuity. There is a joint life annuity. There is something we call last survivor annuity, and many others. But the main one is single life, joint annuity, last survivor, and a guaranteed annuity. Of which single life means it is you as the purchaser who is being paid per month. Joint life, you take it with your spouse. Maybe your spouse gets a certain percentage, and you as the principal member gets a certain percentage. Last survivor means that it will be the person who survives the other is the one who will continue receiving the monthly pension for up to the time the last person dies. So when you choose the premium, when you choose the annuity, please look at all those quotes and be able to see, make a decision out of an informed angle rather than just doing a blind purchase. So having said that, on annuities, the Retirement Benefits Authority asked quite a number of members of pension schemes raised an issue with the Retirement Benefits Authority if they can have an option, because as it was that members were limited to annuities, but that members don't find it very easily, because what that meant is that you only have one option in retirement. So the Retirement Benefits Authority came up with another option called the Income Drawdown Fund. So what happens with the Income Drawdown Fund, unlike annuity, remember for annuity, if you give 2 million to the insurance company, 3 million to the insurance company, that is the end of it. You'll never see that money back again. Their business is to pay you monthly and full stop. But for an income drawdown, it's giving you the option of transferring 10 million into, or 2 million or 1 million, whatever the amount you have. Then you will be paid a monthly pension for 10 years. Say 15%, which is the maximum that you can access, but you can request for something lower than that. So that 15%, or you are plus that income, the fund value that you've transferred is being invested. So you will find part of the 15% that you're accessing every year is part of the income that is being generated for that scheme. So after 10 years, you will remain with something out of the pension money that you transferred. So after those 10 years, you can decide whether to transfer to another income drawdown fund, or purchase another income drawdown fund, or access the lump sum amount, or purchase an annuity, depending on the choice you will make after 10 years of mandatory scheme membership in a drawdown fund. The income here is not guaranteed, but is entirely dependent on the performance of the underlying investments, has flexibility as regards investment choice, frequency, timing, and amount of income withdrawals. In selecting an income drawdown arrangement, members assume the investment and longevity risk. So there is something here. The difference between mainly an income drawdown and annuity is what we call on the investment risk. When you transfer money to an insurance company to give you an annuity, you transfer the risk to them. But when you purchase the income drawdown, the risk is borne between you and the service provider, in the sense that if the return, and especially more on your side, if the return is lower in any particular year, that means it affects how big your fund will grow. And it will mean that your fund will not, in the next few years, it will keep diminishing. So you must always be very vigilant, attend every year's AGM for the income drawdown fund, be able to ask tough questions, check out whether your interest has been credited to the scheme or not. And the good thing is you have full control on the withdrawal amount. So please be very careful, be very keen It is a good alternative for members, those who don't want to take their money to insurance companies. You can always do an income drawdown fund as an alternative, and rightfully so, you have so many advantages, but the risk element is something that you must be aware of and be very clear on, because it will affect you in one way or the other. So please take care of note of that. The difference between a conventional annuity, yes.
Davis, allow me to interject. There is a question here that Sarah is asking. So if you pass on after 30 years and you had purchased for 20 years, does it mean for the 10 extra years there is no payment?
You will continually be paid, but immediately you die. As long as the guarantee period had already expired, immediately you die, that is when the annuity stops.
Okay.
And as I mentioned, that is the advantage income drawdown fund has over an annuity. Income drawdown fund is that even if you die at whatever age, the pension money that will have remained in the scheme will be paid to your members as a lump sum amount, will be paid to your nominated beneficiaries as a lump sum amount. Unlike in an annuity, where if you die on the 30th year or whichever the year and you had not guaranteed, or your guarantee period had expired, the annuity stops. For an income drawdown fund, whatever the money that has remained in the scheme is paid to your nominated beneficiaries. Yes, Monica.
She goes on to again ask, so what are the average interests for voluntary contributions?
There is no average interest for voluntary contributions. Is that the performance of your pension investments or savings is dependent on market performance. It's not like the AVC gets a different preferential treatment or non-preferential treatment from the conventional investments or savings of a pension scheme. No, all the money are invested under one investment vehicle through your pension scheme or through the preferred pension scheme. So averagely though, you will find that most schemes over the last 10 years have been giving an average of 10% return. So what that means and what I'm trying to explain is that some years you will find the return is lower, some years you will find the return is very high. On average is what gives us a 10% average investment income.
Thank you, Davis. Mary is asking, from experience, what steps have successful retirees you have come across taken over the years of their work life?
Okay, successful retirees, I'll probably handle that at the end. I have a slide or two slides that is talking about something to do to prepare for your retirement. Maybe if I can handle that as among the last questions.
That is okay, Davis. And Florence is asking, on withdrawal to purchase a house, do you charge?
Okay, I'm not sure what she means by charging, but remember the withdrawal to purchase a house is just like any other withdrawal. You'll be taxed. You'll be charged tax on the same.
Thank you, Davis.
For us who are processing, we are not charging you or we are not penalizing you for making that transaction. But for tax purposes, you'll have to pay for your taxes.
Okay,
applicable.
Thank you. Thank you. We can continue. Thanks.
Okay. So I've mentioned that on income drawdown is sometimes if you fall into the good years, you'll get very good income, investment income, flexibility also to suit a long-term strategy and a return of fund. But something else also to mention is that you can choose. If you don't feel like you want fully an annuity, you are undecided whether you want an annuity or an income drawdown, you can split your fund. If it is enough fund, split your fund, put some money in an annuity, put some fund in an income drawdown fund. Both of them, we as Octagon have the ability to get you quotes for the income drawdown fund and the annuities and be able to advise you which annuity or which insurance company gives better in annuities, which one doesn't, which one delays in paying claims, which one doesn't, which one pays well or in time, which one doesn't. That is why you need us as Octagon, as your insurance broker, to be able to advise you. When you have a problem, you need somebody to intervene on your behalf. That is why I'm mentioning that you need a valued insurance broker like Octagon to be able to help you on that. There are potential downsides in income drawdown. One of them I said is volatility in investment returns if there is no prudent asset allocation. The other bit is you might outlive your money, assuming you live for over 30 years or 40 years after your retirement. Is that what that means is you'll keep depleting your fund and you'll keep getting lower and lower monthly income with the time compared to an annuity. Remember, for an annuity, you could have easily gotten a level income for as long as you live. If a level of expenses are also high in that scheme, that also means it's eating up into your fund. So that said, that is basically what it means. The features of an annuity, features of an income drawdown, the difference, the advantages and the disadvantages. That said and done, I want to take us to something else, just a slide on what we call post-retirement medical health challenges. Ladies and gentlemen, those who are old, those who are young, there is something called medical health for retirees. One thing is that when you retire or when you stop working at your current employer's place, they'll stop giving you a medical cover that they are currently giving you. So what is your cost of recourse if you don't have a medical cover? Remember, medical health in Kenya is extremely very expensive. It's extremely very expensive. So you need somebody to help you, to hold your hand so that you are able to take care of your medical challenges. NHIF might not be able to pay enough of your bills. Fundraisings are not helping anymore. COVID has been here and has taught us very difficult lessons that you even end up selling your own land to pay a bill of 2 million. So in that, then the Retirement Benefits Authority came up with what we call guidelines on providing something called post-retirement medical cover for retirees. So every retiree or every person, not necessarily a retiree, should put aside some money per month, per year, per quarter, or annually to be able to save something to purchase medical premiums for inpatient, outpatient, dental, and optical, and for any type of diseases in retirement. So if you have put aside your pension money or part of your additional voluntary contribution as a savings for post-retirement medical cover, in retirement, you can transfer that money to a PRMF fund, where in that PRMF fund, you can be able to ask or look for a negotiated cover for post-retirement medical cover so that that can cover for you up to retirement. So members will cease to be covered under your employer scheme. Post-retirement tends to be the time when an individual incurs higher healthcare costs due to diseases associated with aging. Most mortalities in early retirement are health-related. There are few available medical insurance covers for the elderly. Most insurance stop at age 65. Employees who outlive their life expectancy by at least 1 year average is 66%, and by more than 10 years, 29%. That is by Towers Watson report. So RBA gave out guidelines on post-retirement, but I'll not go through all that. Just to mention to you that we as Octagon have a suitable post-retirement medical cover. So the moment you see you are hitting age 60, you are stopping to work, please come to us and ask us, Davis, Octagon, can I find a medical cover that can be able to take care of me until I die, or God forbid, or until I live forever that I live? We have a cover that covers you until even age 90. You are covered. You have a very good inpatient limit. You have a very good outpatient limit. You have a dental, optical. We cover you on COVID-19. All you need is to pay a small premium every year. We have arrangement with an insurance companies on that. So make sure that you come for more advice, and we can also be able to get you a quote that is able to fit your specific family or your specific individual. That medical cover can also be able to take care of your spouse and children who are below 24 years of age if they are still students. On this particular slide on the screen, when you are 25 years, you used to think you are too young to think of pension. Oh, and then you go to 35. You said you will think of pension when you hit 45. When you hit 45, you were so excited about life, and you had too many problems to think of. You had mortgages, you had loans which were cracking your head. You forgot about it. You have remembered it when you are age 55. I should have started 20 years ago. But we are telling you it's not too late. Look at this Mzee who is 75. is when he's saying he should have started when he got his first job. What is your age? When you sit today and do what you call introspection, when you come to Davis at Octagon to get your quote for annuity or income drawdown, what can you be able to get an income that can take care of you for retirement? Yeah. Something also important to mention is that we as Octagon have a special rate that we have with insurance companies, so we can always be able to negotiate very good quotes for you with insurance companies so that you have a better annuity which pays you more and which is better guaranteed and has better features. So look at that, make sure you guarantee your retirement. Even as we come to the close, as we approach the end, there are some things that we need to learn. Guide to a happy retirement. To some, retirement means quitting work altogether. To others, it simply means slowing down. The journey to retirement should start when one starts working. Adopt a phased approach. That thing that you asked Monica, the client who asked, I think she must be Florence, or who is that? The journey to retirement should start when one starts working. Don't wait until age 40. Don't wait until age 45, age 50. It will be too late. You might start saving, but you might not be able to save as much as money possible to be able to help you live a comfortable life. Remember, even if you will have a side hustle, even if you will have businesses to help you get some money, it is always better. Business is predictable. It's not predictable. COVID-19 has shown us that the government can close down your day, can put you under lockdown. You can't be able to move from one town to another. But government will never put lockdown on your retirement money, will never put lockdown on your monthly annuity. You will continually earn your monthly income, whether there is lockdown or there is no lockdown, whether the country is closed down or not closed down. Please make sure, even if you have what you call your business, which you are comfortable with, always ensure you are saving for retirement. Never too late to start, no time like the present. Articulate the challenges one would face at different stages of life in retirement and plan for them. One of them is health. How are you going to deal with health when you get to retirement? Define your dream at retirement and ensure the dream is firmly grounded in careful analysis and practical planning. That is why we are telling you, come to Octagon. We'll be able to give you a proper analysis, show you how to plan for that retirement. If you need to know how much more you should start saving so that to live a more comfortable life, we have a system that can be able to calculate for you that. Talk to us today. Plan your exit from regular employment. Most of us sit pretty comfortable in employment. Please plan for your retirement. Get to know when you are retiring. When will you exit? Start working backwards and know what to do and what not to do. People who leave a job voluntarily are likely to be happier in retirement than those who are pushed out. People who retire on their own terms have a schedule and better opportunity to get their post-work finances in order. The shock of retirement is usually overwhelming for those not mentally prepared for it. It pays to recognize the possibilities of being compelled to stop work because of ill health or downsizing and need of some advanced planning so as not to be caught off guard. Look here, keep busy and keep healthy. That's why every one of us is being told, drink a lot of water, eat properly, eat at the right time, don't overeat, don't undereat, don't skip meals. If you eat, this is the type of meals that you should eat. There are some meals, don't overeat meat, don't do that, don't overdrink. If you have to drink anyway, active religious and social work usually attract no monetary reward, but it's extremely very satisfactory in retirement. So for those successful retirees, you are even likely to live longer if you are involving yourself in religious and social work. Seek something to do part-time. Research study shows that consultants on retirement contributes up to 50% of income generated by retirees. So find out something to do. That skill you've learned for the last 30, 40 years that you've been working, use it to do something else so that that can give you income. Keep healthy. This affects the quality of life you wish to live. So planning for retirement, have a positive attitude. Retirement is not the end, but rather the beginning of a new life. And I say it here again, retirement is actually the longest holiday. It is the honeymoon that you should have of your life. So you can't go for honeymoon if you don't have money. You can't. So that money, it is you. Unlike for wedding where we have to fundraise and get you money to do your wedding, for retirement, there is no fundraising for people for retirement. You must have your own money. You don't have, you will have to die alone, like somebody who never was planned in life. Be like this flower that is blossoming in the middle of a desert, and that the only way that it can blossom is to keep healthy. Whether it is financially, religiously, socially, economically, or politically, be like this sunflower that is flourishing in a desert. And lastly, very lastly, is life begins at 60. Life begins at 60. Forget about what they told you that life begins at 40. 40, you don't have any saving. You don't have anything you have achieved in 40. You have probably, you still have children who are still in school. It is assumed that you should have planned properly so that even by age 60, all your children should have stopped working, should have stopped going to school, so that you stop also paying school fees. So immediately you clock age 60, you are saying, hooray, eureka moment. Let me book a flight. Let me go to somewhere and go to South Africa or go to Dubai or wherever that place is, and go and spend your money. Go and relieve yourself of all the stress you've had for this life, and go and flex your muscles. Go and rest, because now the time you are donated to your employer, it has been left back to you. So I want to stop there and give room for questions. Monica, over to you.
Thank you very much, Davis, for that elaborate presentation. I'm sure most of us here have been able to learn one or two things that we're not sure of, and we will now be in a better position to make informed choices, especially on matters retirement. You can continue sending in your questions using the Q&A session so that we can take them before we close. For those who are requesting for more information about the medical schemes, the annuities, and the income drawdown, you can always write to us at our email addresses, support@octagonafrica.com or insurance@octagonafrica.com. I've also shared the same on the chat. Davis, Florence is asking, at what age can I draw funds for residential house?
Any age, Florence. Any age, as long as you have sufficient money that can be able to help you purchase. So there is no limit for age. Luckily, there is no limit for age. What is provided that as long as you don't spend more than 7 million or 40%, you don't spend more than 40% of your pension savings, or more than 7 million, whichever is higher.
Okay. And then we have Sarah who's asking, can we start paying for the post-retirement medical scheme in advance and then we access it upon retirement?
Actually, that is the program, Sarah. You need to start, if you are employers, probably, Sarah, what we will need to know is, are you a client of Octagon? Or even if not a client of Octagon, can your trustees, we can always talk to your trustees. Our actuaries can get in touch with your trustees if you let us know which scheme you are coming from, and then we'll get in touch with them and talk to them about how to set up a savings plan for post-retirement for all your employees so that you can also benefit. In the absence of that, Sarah, we have an arrangement under our Octagon Personal Pension Scheme where employees or individuals can be able to save under our medical savings scheme and be able to have an annual statement, have your money invested and earn investment income every year. At the same time, you can use that money for your medical premiums and bills at retirement. Remember that money, it is your money. And even if you are stuck with diseases midway here, you can use that to pay for your medical bills if you get sick upper katikati. But until then, you can use it for retirement, post-retirement medical cover in retirement.
Thank you, Davis. Sarah, I hope you're okay. I hope you're able to hear us. Mary is asking, what is your take on schemes that are declaring a 2% return? What could be the issue?
A 2% return?
Yes.
Okay. Maybe to mention, who is that, Monica?
Mary. This is
Mary,
Mary who's asking.
Okay.
Yes.
Okay. Mary, just to mention is if your trustees are giving you a 2% return, you need to knock at their door and tell them, please, ladies and gentlemen, it is time to wake up, because 2% return is going to make me not to earn or to have a better retirement plan. So you need to knock at their door and tell them, please, ladies and gentlemen, wake up, invest properly, do prudent investments for my money so that you don't retire a poor person, Mary. Because much as you can contribute, if your money is not in a good investment income, on average of 10% every year, then that means you will have a problem in retirement because you will not have as much money as possible. From that slide I shared for additional voluntary contribution, you notice there is a very serious difference between somebody getting a 4% return every year for the 30 years and somebody earning 10%. It makes a big difference when it's even a larger period of time that you are investing that money with them. So you need to knock their door and tell them, look here, we better do the right thing.
Thank you, Davis. It looks like we do not have any more questions. So I'll take this opportunity once again to thank all those who took their time to join us in today's session, to get to continuously learn more on matters retirement. We totally appreciate your support and you taking the time of having been here. Remember that we are still at hand to assist where you need us to. You can always send us an email to both our email addresses, support@octagonafrica.com or insurance@octagonafrica.com. Then we will get to engage you more. Otherwise, for today, I think the session is officially closed. I want to thank you once again. And we will see those who've not also had an opportunity to have this session again next Friday. So once again, thank you, Team Octagon, for having this presentation. Thank you, Davis. Thank you, Jonathan. Thank you, participants. And I wish you a blessed day and weekend ahead. You are free to leave. Thank you very much.
Thank you also, Monica. We can remind them to invite their other staff members to join next week's session for even a more engaging platform.
Thank you, Monica. You have a good day.
Thank you. Bye.